Hello and welcome to Market Psychology presented by spreadbettingportal.com. In this video we're going to look at what market psychology is. It's probably something that you're familiar with, or it may in fact be something that you've heard of and probably think that you know what it means but don't truly understand. In fact, it's very common for people to, certainly in trading, to understand, well, not understand, but feel that they understand something, whereas in fact what they understand is just a sort of a common misconception of what that particular aspect of the market is. So we'll be covering, in a nutshell, what market psychology is, what it means to be part of the market and the psychology of it, and how the sort of the masses behave within that market, and also how you as a trader, whether new, old, or never even traded, can take advantage of that. So let's just examine first, what does it mean to be, and what is market psychology? Well, basically it's just fear and greed. Now, we've all heard of what these statements fear and greed mean. The fear is, that it's twofold in a way, in which we'll discuss later, but primarily fear is just the fear of losing money, and it's also partly fear for not getting into a trade when it's going in one direction, and you can see that happen. The greed aspect happens when, say for instance, you're in a trade and instead of getting out when you should, you're staying in because you're being greedy. And because you're being greedy, this tends to lead to issues where you end up losing more than you would have if you'd actually got out at a sensible point where all your analysis was telling you when to get out. So in essence, it really is fear and greed, and that's pretty much what drives the market. And in fact, when you look at the markets, when you look at the charts and everything, and there's so many, it's really pointless me showing you a chart because there are so many variations of that. But they're all pretty much the same in the respect of sort of market psychology, in that we see it's obvious in the market when we see strong trends, and whether bullish or bearish. And it is this where fear and greed is coming in, and it affects us all. And in fact, it's kind of what the average trader it thinks or fears is going on. It's kind of that gut feeling that's happening in the market, and we're all kind of all part of that, and we see that day in, day out in the markets to a greater or lesser extent. It happens almost in many markets, many charts that you'll see. You'll begin to see variations of where this fear and greed come in. And it really is how the majority act in any given situation. And unfortunately, many new people, new traders, and in fact some experienced traders, actually trade with the herd. They get kind of carried away. And in some respects that can work. But that doesn't mean to say that the herd is correct. It just means that you're going along with a very particularly strong trend. Now, if you're just blindly doing that as the herd does, then you're just reacting, and that's one of the worst things that you can do as a trader. So why do we do it? Well, it's essentially we are naturally social creatures. We don't want to be seen. It's not natural for us to move against what others are doing. We don't want to, even maybe we don't care about what other people think, but it's kind of deep rooted in us to act in that particular way. So when a given situation arises, there is a very strong chance that we will react in a particular way. It has nothing to do with how skilled you are as a trader or how much you know about a particular company. It has a lot to do with how you understand yourself, and if you can understand yourself a lot, then this will make you a better trader. But every trader kind of has this little battle at some point in their trading where they kind of feel that they want to do it, where they want to sort of act on a particular trade, not because of any technical or fundamental reason, but because they're seeing what's happening and they don't want to be left out. And this is kind of where the herd mentality gets in. So you don't want to be part of that, because you're trading with the herd, you're trading blindly. And even though it's the most natural thing for us to do, and it's reflected in almost everything that we do in life, we kind of naturally do these things. For trading, it's not great, because we're moving away for the real reasons why we are trading. So why not? Why not go with the herd? Well, one of the main reasons is that when the herd gets to an extreme, it can cause bubbles, a market bubble in these markets. And we've seen it so many times. And it's usually when the professional traders are kind of almost sort of exhausted. They kind of got a little bit bored with it. A particular trade, stock or option or chart, for instance, and it's then the kind of the retail traders, the sort of normal average man in the street that does a bit of trading, gets involved, and they sort of don't really understand technical analysis or the markets, and they're kind of dabbling. It's the dabblers that cause the problems. And these dabblers, they will buy because they've read it in the paper, or they will buy because their cousin has bought something, or they will buy because the cabbie said what a great investment it is. And you will almost guarantee that it's a buy. It's somebody buying into the market with it going up. Rarely is it people looking to short the market. It's always the bubbles that are caused with these in that particular direction are always bullish, and they just get caught along with what the media is saying, and this kind of breeds an excitement. And we've seen it, for instance, quite recently with Facebook and Apple. So can you benefit from this? Well, as we know, markets move in trends mostly, and if not, they're consolidating. And obviously it's an incredibly good idea to have a huge understanding of what technical analysis is, and a good feeling and an understanding of fundamental analysis. The question then that you really need to begin to ask yourself is, can you benefit from this? Well, first of all, before you look at whether you can benefit, and the answer is yes, of course, you actually really have to understand what technical analysis is. You also have to have a good understanding of fundamental analysis. So I'd strongly urge anyone, before you start to look at market psychology and the herd and start to read more about it, that you really get your skills in terms of how you work and understand technical analysis, and how, maybe to a lesser degree, that you begin to understand the fundamentals as well. But it really, I would say that 100% you have to learn technical analysis. And if you really want to look for points where, say, market psychology is sort of pushing things, and we're seeing this herd aspect kick in, which is predominantly what we're talking about here, because we do see market psychology sort of appear in other points of trading as well. But here we're talking about the herd and how you can benefit from that. So first of all, really understand how the technical analysis works. It's a huge subject, but there are plenty of videos on this site that you can watch that will begin to help you along that road of understanding technical analysis. So first of all, you have to understand that markets move in trends mostly, whether bullish or bearish, up or down. And if they're not doing that, they're going sort of sideways within a range, which is called consolidating or consolidation. So once you understand that, and you understand where the technicals are in terms of resistances and supports and so on, you can begin to understand for a particular chart. And not all charts are the same. They all tend to sort of almost have a personality of how the charts, a particular chart, even a particular company of a chart or a particular type of chart, can work. And you get this kind of psychology, personality of a chart sort of showing through. So not all charts react the same way to a given situation. So charts do kind of have a personality of their own, and therefore it's a good idea to also understand a particular chart. And that's why sort of the very big companies, so the likes of Google and Apple and so on, become quite popular in terms of people watching them, because they are so popular and because they're traded so much and because they're worth such a huge amount. And there's a lot of profit to be made from these moves. Then there's an awful lot of analysis being taken on just those charts, and you begin to see this kind of personality of a particular chart work. And once you understand how that chart works, how a particular chart is acting, you can begin to see where the herd perhaps is getting involved. And one of the things that you have to understand basically is that even if the market is trending, doesn't necessarily mean that it's a herd, that the herd has got involved. It just it's just trending naturally within a range, or technically it works. If it's working as a trend and it's working within the technical aspect, chances are the herd have not got involved. But when the herd get involved, it's where almost they just ignore all the technical aspects there are, because they kind of don't understand it. They're getting involved because of the excitement, the potential for profit, and all those things. So those are the things that they're getting involved in. They're not looking at the technicals or the fundamentals of the chart. So yes, you can benefit if you can spot when that happens. So you can benefit, but can you really benefit? Well, yes. Is when you can understand when the market is becoming overbought or oversold. But predominantly, if the herd are getting involved, it'll become an overbought position way beyond any sort of technical reason. And then and this is kind of where your understanding of technical analysis is key, but also your understanding of a particular chart as well. And once you tie those two together, and your knowledge is of a level of that chart and of analysis, you can see that kind of whoever's getting involved in this chart trade, and it's still pushing upwards, and there's no sort of technical reason as to why that is. But we're seeing sort of huge spikes, and it's getting hugely overbought on a lot of indicators. Chances are that we're beginning to see that the herd are getting involved. So once you begin to understand that, you can start to begin to see where the patterns of the herd are becoming involved. And to take advantage of that, you could say, well, maybe I could just jump along with the herd. The thing is, because there's kind of no real technical or fundamental reason as to why the chart is moving other than the herd mentality pushing it, it's incredibly fickle in terms of, and hugely unstable as to when it will turn, because you have no barometer, no guide as to when that's likely to be. So to jump in on, say, a long bullish move that has no technical reason as to why it's happening, or no fundamental reason to, then you're risking a lot. But there are things to look out for. For instance, you can go you can begin to go short when you begin to see or look to go short when you start to see periods of consolidation within the sort of the intraday moves, when you start to see these periods of slowing down and where it's starting to get so excessively overbought. You can then sort of position yourself as on a short, and short, they tend to sort of either crash in a very huge way, as we've kind of seen with Apple, or they do it in stages where, again, we've kind of seen that with Apple too, where it's kind of dropped and then get a bit of a plateau and then dropped again, and a bit of a plateau and going up a bit and then dropping again. So there are ways in which you can benefit, but certainly you don't trade with the with the herd. It's an incredibly dangerous thing to do. And as we said, and as I said, Apple's one, but Facebook is another one. The excitement has basically got beyond the true market value. It has no sort of basis. It's not based on fundamentals of the earnings or the profits. And then by looking at the points of weaknesses in the trend, near overbought points and new highs, these can lead to these huge sell-offs. And by getting involved in those, by jumping in and going short at the right time, obviously, it doesn't necessarily have to be right at the beginning. In fact, it's incredibly difficult to spot when a huge bullish move like that's sort of powered by the herd is going to turn. It's just incredibly difficult to do. So it's usually best to see it happening, because it's gone up so much. It's going to fall a great deal, and it's going to get points where people are going to move back in. So we're going to see sort of a sell off, and then it's going to sort of find a bit of a plateau, and then it's going to go up again a little bit. You got to be aware of that. So these examples of Apple and Facebook are extremes, but you have to understand that it's the opportunities are everywhere. Apple and Facebook are huge extremes of this, and we see bubbles in the market all over, and this is usually called just basically by the herd. And you also have to understand that even normal traders do get caught up in the herd. It's not uncommon to get that excitement and get involved. We saw that too with Facebook. It was valued more than Google, yet it wasn't making anywhere. I think it was making like 10% of what Google was making. And yet, because people were using it, they were familiar with it, and the Facebook's brochure, their proposal before their IPO was so positive and so incredibly well written. You'd believe that they had found the ability to create gold or something like that. That whatever they touched, it would turn to gold magically. It's kind of how you were led to believe from their proposal. So you kind of have to look out for things like that. So sadly, even normal traders got caught up in that. And usually, it is when the trend fails to break in either direction and everyone jumps on board. Usually, though, if it's the herd and it's the general public, they have very little concept of going short. So chances are, if it's a short that's happening, it will be a lot short-lived. And it will be predominantly traders jumping on board, retail traders jumping on board and getting excited on a drop. If it's a bullish move, that's more likely to be where the herd, the general public, are getting involved. So why does it kind of happen? Well, it's partly because people hate to miss out on things. And it's usually when the market is trending massively, and it kind of powers the other. And that fear is twofold. It's the fear of not being involved in something, the missing out part. People don't want to miss out. When they see it and they've heard Joey, their next door neighbour, who's bought 100 Apple shares and they're now worth £20,000 more, and it was only like 3 months later, and he's so excited about it, he's telling everyone, and you're thinking, oh shit, I want to get involved in that, I want some of that. So it's that whole fear of not being involved. So, and then the other one is if you're in the trade and it's not wanting to get out early. You don't want to get out because your fear is that you're going to lose out. You're going to lose out on profits. So people stay in right to the end. And then when even that falls and that collapses, we begin to see a really bizarre thing of when people stay in still. Even though the market is going down, we still see people staying in the market, staying in that trade, because they either believe it will turn around or they just don't want to let it go. And it's crazy. So these two things are almost entirely 100% born about not understanding analysis at all, and just going on fear on what their neighbor is saying and what they're reading and their own gut instinct on it, which is usually wrong. And it is these that are combined that create the herd. So you have to really understand, to sort of stop yourself becoming part of the herd, is to understand yourself, understand how you act as a trader, and understanding that there's spin everywhere. The media is huge, it's pervasive, it's intrusive, it's in everything. And when you've got huge companies like Apple and Microsoft and Google, and they will do their best to make whatever news sound the most amazing thing in the world. So don't get caught up in it. Don't react to it. Trading is not about reacting. Trading is about analyzing and making measured decisions, and knowing when you're getting out, and knowing what it will cost you if you got out and and it was at a loss, and you knew what your losses would be before you made the trade. It's about not reacting, because if you're reacting, you're not trading, you're just gambling. You might as well just go to a casino. So it's about understanding yourself, how you act as a trader. And this is kind of why older people make better traders, because they understand themselves better and they make more measured decisions. And also think, sometimes the best action is no action. It doesn't necessarily, a lot of people force trades. And this kind of forces the herd thing again. Then don't trade with the herd. Think why they are doing it. Don't look and think, oh, I must get on board. This must be the next big thing. I'm going to make a fortune doing this. Don't. Just think, why is this happening? And again, this is part of the whole not trading with the herd thing, and it's basically trying to develop a contrary view to the herd. Once you understand sort of contrary trading and understanding the herd behavior and the mentality of when that happens, you can not only save yourself an awful lot of stress, but you can, when you get them on the right side, it doesn't happen every time of course, but when it does, you can make a good amount of money.